Welcome to today's masterclass. My name is Jose Rivera. I am the CEO of CSIA, and I will be your host today to this members-only virtual event. I would like to remind you that the membership renewal process has started. If you get your membership renewed by the end of November 30th, your name will be put in the raffle for one complimentary registration for the 2022 CSIA Executive Conference in Denver, Colorado. And at the same time, mark your calendar for our conference, back to in-person conference next year. With hundreds of qualified integrators and suppliers, the CSIA Industrial Automation Exchange helps system integrators, industry suppliers, and manufacturers connect and do business. For system integrators and partners, it provides a platform to support your content and search engine optimization, marketing efforts, position yourself as a thought leader, and nurture prospects during their complicated buyer's journey. Today's virtual event is sponsored by Siemens and ePlan. I would like to provide both with the opportunity to share a few words before we start our keynote presentation. Ben?
Great, thank you so much, Jose. And howdy and good morning from a rainy and wet and cold North Texas. It is, well, at least it's cold for us here, but I just want to take a few minutes, and I appreciate the opportunity that we've been given here today to present Brian and ITR Economics to the CSIA team here. I'm relatively new to CSIA, and I'm excited to be part of it, and really looking forward to meeting you all in June in Denver and shaking hands. But a little bit about me, just so you guys know who I am a little bit. I've been with Siemens for 15 years. Been in customer partner facing roles, background in industrial automation, business development, marketing, sales, and I'm here in Dallas, Texas. If you want to follow me on LinkedIn, you can use the QR code there. Just pop up your camera app on your phone or iPad and scan it, and you can follow me on LinkedIn there. We'd love to network with you guys and learn more about your businesses and kind of what you guys are seeing out there in the industrial market. I also want to take just a moment to say a little bit about Siemens in general. Some of you may not know what we have to offer, and I represent our solution partner program for the US. We have 97 USA-based solution partners, which we basically our certified integrator program. We have 1,500 plus globally. It's a global program, and we have specialties. Our partners include automation, SCADA, process control, motion control, drives, CNC, cranes, printing, converting, glass, and marine, just about anything you can think of in the industrial market space. We have solution partners that are trained and have vast experience in those in that marketplace. And the vast majority of them are also CSIA members, which I'm very proud to have as well, including some of them that sit on the board for CSIA. So we're really excited to partner with those system integrators and bring them into our solution partner program. If you'd like more information about our solution partner program, you can also use the QR code there on the presentation. Again, just scan that with your camera app on your phone, and that'll take you right to our solution partner homepage, where you can read more about the program and also potentially find a solution partner near you if you do need some extra help or need to find some support with Siemens applications. And on the next slide here, what we'll have is I also still get a lot of, when I'm out meeting new partners and new integrators that may not be familiar with Siemens, we're still kind of referred to as that German company. And really, in fact, we are really a USA-based company here. We have over $17.2 billion in annual revenue here in the United States, a strong export market where we're actually exporting products out of the US to other countries, 40,000 plus employees over all of our businesses. We buy from 24,000 different U.S. suppliers, and we have 26 manufacturing sites. And I tell you all that not to brag about how big we are in the U.S., but also to tie this into what Brian's going to be talking to you guys about from ITR, is that we are also very in tune with the economics here in our own country and obviously globally as well. And so I'm really looking forward to learning from him and hearing his thoughts on this as well, as I know you guys are too. And so with that, I will turn this over to Sean, our other sponsor.
Yes, thank you, Ben, and thank you, Jose, for having us here at the CIA event. And we're proud to be a sponsor of the event. And from my side, welcome. My name is Sean Patrick Mulhare, and I've been with ePlan for 28 years now. I'm located in Detroit, Michigan, so a little further north than you, Ben. It's actually sunny out here, but it's very cold. So getting ready for the winter. And so, yeah, from my side, welcome. And I'd like to give you a couple of words about the company and who we are and what we do. So ePlan is part of the Friedhelm Lowe Group, and the Friedhelm Lowe Group is a group of different companies. It's a private company. Included is the company Rittal, so probably the company you know best out of this whole entire group, which is the world's largest manufacturer of controls enclosures. So we are represented in over 50 different countries worldwide. We provide solutions and controls enclosure through the Friedhelm Lowe Group, specifically through Rittal. ePlan is one company out of that group. So if we go to the next slide, the company ePlan, we have ourselves about 100 or 1,000, about over 1,000 employees. Again, participating in over 50 different countries of the world, providing software services and expertise in the controls engineering environment. We have over 58,000 customers with over 190,000 licenses. So from a controls design software perspective, we're one of the largest software on the market right now. Next slide. And this is an overview of our different solutions. So as you can see, if you look at the entire engineering process, we typically start with mechanical engineering, then we go to controls engineering, and then we go to software engineering. And right in the middle, all the controls engineering aspect can be designed and planned with the ePlan solutions. So anywhere on a machine where you have a motor, you have a cable, you have a control cabinet, you have terminal strips, you have a drive, you have protection devices, all of that information is captured within our environment. And that's the ePlan platform. And the ePlan platform is there to capture all the controls equipment and generate the ePlan project. Additionally, we also interface with various different solutions. So if you have 3D CAD packages, we can interface with the information from those CAD packages. If you are developing software solutions for Siemens PLCs, for example, we can connect through the TIA portal, through AML, and data or transfer data back and forth, and also interface with various different SAP systems or ERP systems. So we are really anything controls automation. We are there to help you design faster, more efficiently, and take away all of the redundant data entry and repeat information or tasks that you have today.
Perfect.
Thank you.
Thank you both, Ben and Sean. And before I introduce the keynote speaker, I would like to remind you that we have an opportunity to ask the speaker questions. So please use the Q&A box that we have. We also have a chat box, and you're welcome to use it to network with your peers on this virtual event. But the questions for Brian should go into the Q&A box. And at this point, I would like to introduce Brian Beaulieu, the CEO of ITR Economics. And I know that several of you must be thinking that I must have meant Alan Beaulieu, the economist that has been presenting at our CSIA events over the years. And I know this can be very confusing, and it's because Brian and Alan are identical twins. So the one presenting today is Brian. And so without any further ado, Brian.
Thank you very much, Jose. And let me get my screen sharing going, and away we will go. I don't know why that went off. Sorry about that. There we go. All right. Hopefully you can see the whole screen. Everything looks good. True? Okay. You
Yes,
seeing it okay, Jose?
Perfect. Thank you.
Okay. You're welcome. We're going to be looking as best we can into the future so that you can really budget effectively, know, at least try and gauge how busy you are going to be. But let me give you the bottom line right now. I'm going to be showing you why we at ITR Economics think that, yes, we've been hyped up in terms of how fast the business has been coming in. Yes, there are supply chain problems that are making life more difficult, but all that's going to settle down into a more normal rhythm. And we see the US and indeed the global economy growing through 2024. So when we're thinking about labor, working capital, time, all the resources we need in our businesses, that's a huge factor. It's not stopping anytime soon, and you're not going to get to rest anytime soon. So now I'm going to try and show you why we think that, so that you have the confidence to make the plans that really are going to allow you to be the most profitable you can be going forward. Part of that assurance from our perspective is, and Alan, I'm sure did this also, all of our speakers, we show you our track record. It's hard for you to have confidence in us if we're not showing you how we have done in the past. And this past that I'm showing you here is one of the most difficult pasts that any of us could have imagined, really. Look at that center column, data forecast. What we're talking about there is March 20th, 2020, March 25th, 2020. So the stock market's careening downward. We're all becoming aware of this monster called COVID. Governors are shutting down non-essential businesses. Clients aren't letting us onto their property because of the pandemic. And we had to scrap every forecast that we had currently going for us at that time. And between March 20th and March 29th is when we tackled these 8 headline items. These 8, by the way, they don't change. They're the same 8 presentation year after year after year. It's our scorecard. So the duration is shorter than you're used to seeing over there on the right. It's only 9 months because we're looking at how we did come the end of 2020. And for GDP, we had a 98.4% accuracy rating because we anticipated that the second quarter was going to be the low for GDP. US industrial production, 96.5%, because we modeled what we thought it was all going to mean and that we'd be rebounding in the second half of 2020. And that's important to understanding the supply chain problems, because the way we approached the problem was that COVID was a natural disaster. It was not an economic disaster. It was, we've seen these, these Ebola things before. We've seen hurricanes, we've seen floods. What we did is we looked at each of those natural disasters and what it meant for the impacted economy. And then we simply scaled it up from there to look at what was going on in the world, what we could expect worldwide. It was a tremendous project. And while these numbers here are, under the circumstances, we think good, the reality is when we show you 2021, you're going to find that the economy in the US in particular in 2021 really performed even better than we had expected it would. Growth resumed in the US in the second quarter of 2020. The blue here is GDP, actual results. Change $2012 simply means that it is adjusted for inflation. The latest quarter is the third quarter flash estimate. And you see how when we transition from the blue to the green, there's a smaller step. The flash estimate is suggesting that, yes, indeed, we are seeing that smaller step. It's a slowdown in the rate of rise. We couldn't possibly keep up that torrid pace. And for several reasons, supply chain issues being one of them. But the consumer is now back into normalized demand mode. Now I have a chart to demonstrate that to you. But we're going to continue to rise. We don't see anything that's going to stop us from rising. Slowing down, as you can see, if you look at the green portion, which are the forecast points, you can see it levels off out there and later on in 2022 and through the first half of 2023. And then it picks back up again. There is no leading indicator input at this time that is statistically significant telling us that reacceleration is going to occur. I have one tentative indicator and I need more than one before I start flashing it around. But from our perspective, it's logical because we expect the supply chain issues are going to start resolving themselves over the course of 22 and on into 23. And then we start seeing businesses perform much more efficiently. We expect profitability, which is now artificially high, is going to resume a more normal rising trend, all of which will feed into this ascent. No recession through 2024. Really for GDP, it's not likely to happen in 2025 either. We're occasionally, I'm anyways, asked the question, are we about to go tumbling down into another recession? I just want to be very clear. We do not see another recession for the United States or the world, really, until 2026, maybe late 2025, but that's a long ways out. So let's just focus on what we are very confident about, and that's this growth ahead of us. So if you're internalizing this, you should be asking yourself, or you should be going through something like, oh my gosh, how am I going to handle all this growth? And that's the hard part. Managing this profitably is not going to be easy given all the stresses going on in the marketplace. We're hoping by looking at some of those trends, talking through them, some strategies can be developed. I'm going to take a look at government's impact on the economy. Before I go into any of that, please understand at ITR Economics, we are politically agnostic. And what I mean by that is we don't really care whether it's a Republican or a Democrat in the Oval Office, or the Republicans or the Dems are running the Congress, either house. It doesn't matter to us. Those are just labels. What we look at are policies. It's the policies that always matter. And with that understanding, please hear me. This government of ours, no matter what happens in the midterm, is likely to be spending more and more money. That's been a long-term trend that's not going to stop. As a percent of GDP, they're going to be spending more money. And right now, there's this pressure to tax. We'll have to see how that goes through. It would be politically precarious for the Democrats to push through a lot and we have tax increases as we approach the midterms. You'll have to see if they're going to do it. What we do anticipate, though, is over the longer term, the pressure for tax increases is going to be rather relentless. And by longer term, I mean on the other side of 2026 is when that pressure really ramps up. This is just early days in that process from our perspective. Despite all the deficit spending, despite all the money creation that's been created out of thin air by the Federal Reserve, interest rates have stayed incredibly low. This is the 10-year government bond yield, and this is monthly data. So at the end of last month, it was running at 1.4%. It's going to be closer to 1.58, 1.56 these days. We're just getting back up to where we were pre-COVID. That's all we're looking at here. It's nothing that we can't handle. Certainly, if you look at back to 1990, this has been a very nice, long declining trend, interrupted with cyclical rise, but the secular trend has been one of decline. The bond market is telling us something very, very clearly. It is telling us two things. One, it does not see any inflation. And if the bond market isn't seeing any inflation, why should we be concerned about that inflation? I'm not. The Federal Reserve is not. The bond market says that's looking in the wrong direction, looking for ghosts where there aren't any. Federal Reserve says that this is just a transient bout of inflation. And our analysis says that too, and I'll be showing that to you a little bit later on. And I know that doesn't jive with the labor costs, it doesn't jive with some of the material costs. I get all that. Just be patient. The bond market is saying, don't worry about it, at least not for the next 18 months. That's how far out the bond market can look, is 18 months. And it looks effectively that far out, which is a lot farther out than the stock market. The other thing the bond market is telling you and me is that they are not concerned. The world, which drives this bond market, is not concerned about the amount of money the US government is consuming borrowing. If the bond market, which is a great tell for the economy, was concerned about it, these rates would be higher than they are. It's saying, not yet. We're not concerned about it yet. We're not concerned about the trend. You know, there's so many things you and I need to be concerned about running businesses. You know, if we have something like the bond market telling us, don't worry about this, then that's one load you can take off your shoulders. In fact, given just what I've shown you so far with GDP and how low interest rates are, really the takeaway from these slides so far is maybe you should be borrowing money to invest in your businesses, to grow your businesses. This is dirt cheap money. Banks have more money than they know what to do with right now. They want to lend it. They want to lend it to you. So you go out there and you borrow money to leverage your future. Invest in yourselves, invest in training, invest in efficiencies. Maybe you're going into a new market. Maybe you're rolling up some competition. This is a good time to be making acquisitions. I know the multiples are high right now, right? But that's because A, there's so much liquidity, and B, we have a good 3 to 4 year runway before we have to worry about a problem in the marketplace. That's a buyer's dream. And I also think this is a good time to be buying because people are selling based on a fear of what the tax rate, the capital gains tax rate may be. Then, I get that, but it always strikes me as an interesting play because we don't know what it's going to be. We don't even know what's finally going to get reported out through the reconciliation process. What, if anything, is going to make it through the Senate and the House? And if the House has their way, they're going to make it retroactive anyways, back into September. The ship has sailed. So let's just you and me concentrate on how much profit we can bring into our businesses rather than how much they're going to tax away. That doesn't mean you're not smart about it. I'm just saying I wouldn't worry about that. And I would be more a buyer than a seller at this particular market, at this particular juncture. This is an interesting slide, and I know it may be a bit academic, but there are several key points I would like you to take away from this slide. The brown line is the debt. It says U.S. total public debt, but that's economic ease that's the federal government's debt outstanding. And look along the x-axis. You see it begins to come up in the 1980s, appreciably rising, beginning back then under Ronald Reagan. And then it rises throughout the 90s, then it flattens out a little bit at the turn of the century, and then we've been on a real tear. Interestingly enough, that little flat spot was Bill Clinton. And chances are he didn't mean to do it. This brown line going up is an issue. But as I just took some pains to show you, the bond market is saying it's not an issue today, but it is going to be an issue in the future. And we're living with the consequences of it today. See that April 2009 and that vertical line that just appeared? It was in April 2009 that our debt as a percent of GDP exceeded 80%. In economics, once you go past that 80% threshold, you start doing damage to your economy, particularly when so much of that deficit spending is going toward making us arguably a kinder, gentler, softer, more caring nation. But all the money you pour into people like that, whether it's Social Security or healthcare, has very little, actually, it has no payback in terms of GDP growth. You're looking at the blue line here, which is US industrial production. You can see before we hit that April 2009, we had a nice rate of growth going in our economy. You hit that 80% tipping point, you go through the Great Recession, you accelerate that deficit spending, and we have less growth going on now. All this deficit spending is inhibiting our ability to grow. So when you hear a politician or a modern monetary theorist, they're called MMT people, telling you that deficit spending doesn't matter, just flash back to this. It does matter. It's making it more and more difficult for you and I to experience the growth that people before us did, or maybe you did before 2009. The management takeaway from this is you no longer want to grow with the overall economy because that's in slow growth mode. You want to grow much faster than the overall economy by being more nimble and by focusing on those things that you can effect change in rather than dealing with the things that you can't change. You and I aren't going to change this situation. Just to further the thinking that we are not party specific, you can see here how the number of times that the Republicans have had the Oval Office versus the Democrats in the post-World War II period, and the average change that has occurred under each Republican administration and Democrat administration average. And it's been higher for the Republicans than the Democrats. Some people get surprised when I show them that statistic, but from our vantage, whether you're in power or you're the loyal opposition, as it's called in other countries, you act pretty much the same. And in terms of reducing this debt, Republicans and Democrats, 5 times, 4 times, virtually the same percentage magnitude reduction. I'm showing you this, and I'm chewing up some precious time to show you this because I don't want you to think that there's some sort of political salvation for us out there, that if only the election goes in a certain way, everything's going to be right again. We make it right for our businesses and our families. But Republican or Democrat, I'm trying to show you that there's not that much of a difference between them in this macro perspective. When it comes to social programs, et cetera, yes. But when it comes to this macroeconomic environment that you and I have to function in, not much different. This is a warning, actually, frankly. You're looking at the US government bond yield again, 3-month moving average this time. And it's generally been declining throughout the 1980s and today. And that is globalization. What is bringing that down is globalization. The new watchword going forward isn't globalization, it is nationalism. You're going to see globalization shrink and each country become more and more an island unto itself. That and all the other reasons you're going to see inflation in the future means that that blue line is likely going to be going up as we finish out this between now and the end of the decade. The brown line there is how much debt businesses have taken on as a percent of GDP. And it was perfectly rational for that line to be going up when interest rates kept going lower and lower. Why not? I even told you today, these very low interest rates, why not? But as these interest rates start going up, you want to make sure that your business is not as much in debt as it may be today or tomorrow. Certainly by 2026, make sure that you're running fairly lean and mean, that your cash flow is strongly positive and that you're paying back debt. You don't want to be carrying much debt between 2026 and 2030, and certainly post 2030. You want to be shedding debt into that period. So I'm telling you to be nimble. Take advantage of these interest rates today, but by 2026, 25, you put that into reverse and you start shedding the debt. Taking a look at the global scene. Here's the US percent of GDP, China, the second largest economy in the world, Japan, Germany, etc. Excuse me. The major player here that is of concern is China. China's growth rate has slowed markedly back to what we saw in 2018, as a matter of fact, when you look at their GDP, their industrial production. Part of that could be COVID, but I think there's something more systemic going on there. You look at the unevenness of the debt, you look at how the central government is shoveling money toward the state-owned enterprises and moving away from capitalism. You look at their labor participation rate, which is declining. You look at their population, which is declining. You look at things like Evergrande going on. I mean, there's a lot of reasons to be concerned about China. And therefore, people wonder, well, what's that going to mean for the rest of the world? That's what I want to address with this slide. Our contention is the communist government of China will not let some sort of catastrophic real estate event happen. They know as well as we do what the problems are within the economy. They've moved to shore up some of Evergrande's debt, and we think they're going to continue to do that, really. So while they're not going to be driving the world forward, I don't think they're going to be pulling the world down. They're less important to the United States now than they were pre-Trump era. And actually for Europe, China's more important now than they were back in 2017 pre-tariffs. There's been this interesting shift in power. But whether you're talking about the US, China, Germany, India, Italy, Korea, Russia, Brazil, it's nationalism. It's all me first. Shortening of supply chains, in other words, is what's going on. The whole world, by the way, is slowing in its rate of growth as we go forward. You see all these leading indicators on this dashboard. And under trend, it says decline. In fact, Brazil's turned a little bit more negative because their decline actually went through a particular technical point that we look at. It could be in red. Slowing rise is probable for Brazil and all these other economies. I say for 2022, ... because until these start flipping around and turning green again, there's nothing to expect but slowing rise. There's no decline that we can see. Those imbalances that normally precede decline simply are not present. But this slowing growth is likely to extend not only through 2022, but 2023, the first 1 to 2 quarters of 2023. And then we expect that reacceleration that I showed you for the US. We expect it's going to be happening for the world as well. Some people look at this and say, this is a little bit worrisome. But we're confident enough in our analysis that there's no recession on this side of the business cycle. Now, this is actually a good thing. This means that worldwide demand, which has been really skewing the supply chain dynamics, is easing. This same data point, declining leading indicators, is true of the US. So we didn't get ourselves into this situation because of a broken supply chain. We got ourselves into this situation because demand was stimulated at such an accelerated pace. So you're looking at Institute for World Container Throughput, their index. You can see where we are today. There's nothing the matter with this supply chain. It is functioning. You can see what COVID meant. That's an unusual decline there in 2020. But we're fully recovered. The world is pushing through containers like nobody's business. It's just the assets aren't always in the right place. That's certainly true here in the US. And the demand was artificially stimulated by treating the economy as if it was broken instead of enduring a natural disaster. So we have this overstimulation of demand, particularly for goods, as Jose pointed out in our pre-meet. And we just are struggling to cope. Assets will get put in the right place. Slowing demand will allow the supply chains time to get caught up. Even here in the US, look, we're running above where we were back there pre-COVID levels. That's what I'm trying to show you with these tangent lines. These are our 5 major ports. I know the media can give you a totally different picture, and I know we've all encountered where something is stuck at a railway depot or a truck depot or on a ship. But the amount of material that is flowing is awesome, and it would be so much worse. This will be remedied. The foundries are being built when it comes to chips. The supply profit motive is strong. But at the same time, you're going to see near sourcing, onshoring, near shoring going on. People are bringing their business back into the United States. And it's not for any other reason than economics. This is something put out by the Boston Consulting Group. You're looking at their cost index, where the US equals 100, manufacturing cost index, and they look at labor, electricity, natural gas, and other costs. And you can see the US is third in from the left. We are at 100. China is 95 to 97. Germany's 116 on the cost index. We're about there with Japan, South Korea. You go over to Canada's 101. It's not like there's a harsh penalty to be paid by manufacturing in the US versus some of these other countries. And other countries that do have an advantage, like Vietnam, 94, is better than 100. They don't score well on the supply chain resiliency index. So what we've observed, what the data is showing, is that foreign direct investment is flowing into the United States so that it can be produced here, supplied here, just like our sponsors are doing, treating it as a distinct, very real, very important market. The same thing is going to be true of France. It's going to be more of a French economy going forward. The strains in the EU right now are interesting, particularly when you look at Poland and they're questioning their role in the EU. It's going to be an interesting future. So just because something gets made here doesn't mean that it's necessarily going to be cost inefficient. So regarding the supply chains, between what we just talked about and now the power outages roaming through Asia, India, and Europe, we're not out of the woods yet. Over the course of 22, these issues will abate because demand is going to slow down, and that'll give supply a chance to get caught up. And the result of all this is going to be more rational commodity prices as we go through 2022 and 23. And that's part of what the bond market is seeing and the Federal Reserve is seeing when it says this is transient inflation we're seeing right now in steel. It will go away. This isn't systemic, which is what they ultimately care about. All right, turning to the US economy. This is a comparison between US total industrial production, which is what you saw before, that slowing growth. That's the blue line here, and then just isolating manufacturing. And manufacturing in the US had been growing better than overall industrial activity up until pre-Great Recession, pre-2008, 2009. And since then, that's where we've had the most difficulty. So this onshoring is simply sort of reclaiming some of the prowess that we have had in the past. Difficulty in achieving this is going to be labor, which is where you folks come in, because everybody knows that the solution for this is automation, AI. You folks you're in the driver's seat. And we're going to take a look at labor in a few moments, but the labor problems that we have in this country and exist in China and in Japan and other parts of the world, they're not going away. Just bring it back to the US. Our labor shortages are going to be with us through the rest of this decade. So if you're in the business of helping other businesses get around the labor problems, then what I'm describing to you is an absolutely fantastic market where the economy is growing, profits are growing, and the need for you is relentless. You start writing your own ticket. Here's the US leading indicator dashboard. And 11 out of our 12 indicators are showing that decline. The only one that's still rising is the retail sales, ITR retail sales leading indicator proprietary to us. And retail sales are still looking very strong, but they are going to start slowing down into more normal growth. Every other indicator has gone into decline, telling us that slowing growth is our outlook in the US for 2022. And I could have the same ... here for 2023. What we're waiting to see now is these declines turn back into rise. It's a little early yet to expect that to happen, but it'll happen when it happens. We just watch it. And when we have 5 rises now relative to just 1 and 11 declines, that's when we can set our watches and anticipate when the economy is going to start reaccelerating. You give me 5 that have flipped either up or down, and I'll show you a statistically significant event based on the last 10 business cycles. I mean, it's just math at this point. But right now it's telling us slowing growth, which means you have some time to get some balance into the business. Slowing growth, but the emphasis, what you should really be hearing is the word growth. This is US disposable personal income. It's just after-tax income, okay? And you see the 3 stimulus checks when they went out, what that did to after-tax income. And that's how we bought all the toys. And we couldn't travel, so we bought all sorts of other goodies to play with or to improve our homes, etc. Those stimulus checks have gone by, and at 15.6 trillion chain dollars, we're looking at disposable personal income about where it would have been, all else being equal, if you look at the trend pre-COVID. In other words, we're looking at normalized demand. There's no problem here. The consumer is going to be able to continue to spend money, but their savings have come down to a normal level. It used to be that there was a stockpile of cash just held in savings accounts, and that's pretty much been used up. So the huge surge in demand is clearly behind us, and now businesses get caught up to what that huge surge in demand created in the kerfuffle. This is a nice canary in the mine for us. This is single unit housing starts. Blue line is a 12-month moving total. So we're taking 12 consecutive months worth of data, adding it up, and when another month becomes available, we lop off that same month 1 year earlier. And on the right-hand side, you see the blue line turns into blue diamonds. That's our forecast. Housing, we expect, is going to continue to climb through at least 2024. A whole host of things are implicit to this that matter, I think, to your lives. One, this means that we don't see interest rates going up enough to damage housing or damage the economy. Interest rates are likely to stay low through 2022 and then slowly begin to rise, but they don't become problematic, at least through 2024. And that's great news. I mentioned a recession in 2026. Housing tends to lead, so it would come a little bit earlier than GDP's 2026 recession. For housing, it would come a little bit earlier. Just take that data point and set it aside for a moment. If you've been looking at a piece of property and you've been looking at the price trends, a fair number of people are thinking, well, maybe, these prices, this is crazy. I'll just wait until prices come down, then I'll buy that property. And when we look at what we think is going to be going on out through 2025 and 26, including with pricing, we don't see prices being reset enough out there in 25, 26 to justify you waiting. You'll still be paying a higher price for that same property in 2026. And you'll also be paying a higher interest rate on the mortgage if you are going to get a mortgage on that property. So the takeaway is buy it now. Why let some other family with their dog doing who knows what in your house for 3 years before you buy it? Buy it now. If it's in the right location, you buy it. In terms of 2026, closing that out, we are not expecting this to go through that tremendous 2006 through 2012 depression. The consumer today their balance sheets are much stronger. You look at how much money is being used to buy houses today compared to how leveraged people were back then. And lending institutions are more careful now than they were back then as well. We are not one iota concerned that that's what we have looking forward to looking at us for 2026, that recession. It's going to be a lot more like those earlier squiggles you see to the left of 2006. Excuse me. It's going to be a normal period. And we see inflation heating up, most noticeably on the other side of 2025, or maybe in 2025. Housing tends to do well during periods of inflation. It boosts the price of housing even further. Alan, Jose mentioned you are very familiar with Alan. Alan always tells me not to say this, but I'm going to say it anyways. Home prices are in an asset price bubble. All asset price bubbles burst. The thing is awfully difficult to know exactly when it is going to have the big pop. But as we look at previous asset price bubbles, including in homes, this isn't the first time, the hallmarks of that bubble going pop aren't there yet. We don't think the circumstances leading up to a pop will be evident for several more years. So again, our encouragement to you is make the plunge, buy some property. In fact, if you own one home, buy a second. If you own two, buy a third. If you own three, what the heck, buy a fourth. Enjoy the ride. You and I live in a CapEx world, non-defense capital goods, new orders, excluding aircraft. The 12-12 rate of change, that blue line, that's taking the capital goods, new orders, 12-month moving total as of, in this particular instance, excuse me, September 2021, and comparing it to that 12-month moving total as of September 2020. And we're rising because orders are right on an annual basis are running progressively higher relative to year ago levels. The green line is the business confidence index, and we run a 112 rate of change over that. So we're just comparing the latest data, October 21 to October 2020. And we have shifted that green line into the future by 12 months. That green line has actually happened so that you can visually match up the highs and the lows. takeaway from this slide is that, yes, there's going to be a slowing in the rate of rise for CapEx out there. And if you look at the timing, it says post the first quarter of 2022, the year-over-year comparisons aren't going to be so bountiful, so manic. But also, at least through 2022, there's no indication that it's going to go into negative territory, just slowing growth. And I wanted you to see that this is a complicated slide that I don't show usually, but you folks have been with us for quite some time, or we've been with you. Rates of change are plotted on the upper portion of this chart, scaled on the left underneath ROC. The thick green line is the 12-12 rate of change that was in blue in the previous chart. And you can see we expect that it's going to be rounding the bend and it's going to come down towards zero, but it's not going to break through that zero line before it starts going up again. Now, what that translates into in terms of data, you see on the lower portion of the chart, that's scaled on the right-hand side underneath MMT, which stands for monthly moving total. So you have the 3-month moving total, which is at a record high right now, and you have the 12-month moving total in green. That's also at a record high. And you see the economy bends, but doesn't break. It's like great defense. It bends, but it doesn't break before it starts to reaccelerate. You know, there's a way you can match how your business relates to this, how it looks to this, how it performs relative to non-defense capital goods new orders. And if you match up closely to what you see on this slide, then you know you may bend, but you're not likely to break unless in your particular market things go seriously awry or you make some missteps along the way. This is North American robotic shipments. And the interesting part of this for me here is in the rate of change on the upper portion of the chart. See how there's that black 26.3, that's the 312. So it's saying for the last 3 months, robotic shipments are up 26.3%. This is in units, not dollars. The 1212 is still negative. So over the last 12 months, we're still underwater compared to the year ago 12 months. But notice how that 312 is running nicely above the 1212. That is what we call a positive checking point. It's like what you saw back there in 2010 when the black line started running above the 1212, or even back in 2003. Now, those are the germane comparisons because of what we've just gone through in terms of the decline. We're shifting out of this decline into a brand new rising trend. That means opportunities abound, and I've already tried to lay out for you the economics and the shortage of labor demand pull we're going to see for these robotics. You lay on onshoring, shortening the supply chains on top of that, and North America robotic shipments is heading into a nice rising trend. And our planning should reflect that. Excuse me, rather than go through all sorts of different markets chart by chart, I have this table for you. Now, some of you are more tied to petroleum refineries. Some of you are more tied to pharmaceuticals or beverage industry or manufacturing, excluding motor vehicles. You can find the line item, and how you read it is that 1212 is, if it's positive, it means we're running above year-ago levels on an annual basis. Phase B means you're in the strongest portion of the business cycle. A for refineries means, yes, it's a negative number, but it's about to turn positive. It's about to flip into a B. The only really negative one on here right now would be automobile production, which is in phase C because of its supply chain issues, particularly as the chips, which we all know about. The other one that isn't as healthy, let's say, would be beverages. It's still positive, I get that. But there's a real issue with input material availability, and particular recycled aluminum cans are a real thorn in that industry's side right now. And perhaps automation can improve efficiencies and therefore help them, but their basic raw material is what's the problem. And the reason I pull them out of the pile is because you'll see that their 312 at 2.7 is running below the 1212. That's a negative checking point, means that things are going to be getting softer. Go up to pharmaceuticals, 14.8 for the 312. Yeah, it's in phase C, so it's that number is going to be diminishing if the trend continues, but it's still so high above the 1212, we got nothing to worry about. Just mild deceleration is the outlook for 2022. So that's how you read everything going on here. Different markets obviously performing at different levels. We don't think the automobile industry is out of the woods and back to normal production levels until 2023. I know there are people in the industry who say, probably too few 2022. We think that's a little optimistic. We think safer to assume 2023. Shifting gears now to talk about inflation. I mean, copper. This is a 312 rate of change for copper, and that 44.4% means copper is still 44.4% ahead of where it was 1 year ago, and it was climbing 1 year ago. But I want you to see with this long-term perspective, though, that this isn't our first rodeo. We've seen times when prices shoot up like this. The 312 has been much higher than what we just went through, certainly where we are today. And you can see how it inevitably resolves itself with rate of change decline. And that means that instead of a 44.4% increase, we're going to be looking at a 20% year-over-year increase and then a 10% year-over-year increase. And as that rate of change gets lower, finally we're flat to 1 year ago. And when that rate of change goes below zero, it means we're running below year-ago levels. We don't have much decline built into our outlook. Let me see if I can find 2014 on that x-axis and go up. See how that 312 dallied a little bit below the zero line, but didn't stay there. Same thing in 1990. That's a useful paradigm for what we see, the slowing inflation. Maybe an 8% price decline out there as the economy softens in 2022 going into 23, but nothing dramatic. And then it starts going up again. You'll get another price run up going on as the world accelerates in demand. It has always been thus. The issue here is twofold. One, there's no major reset in copper prices. We just don't see it happening before 2026, 27. And two, as painful as this is when you're in the B2B space, Federal Reserve doesn't care. They don't call this inflation. They will not run interest rates up because of what's going on in copper or steel or anything else for that matter. They look at the consumer price index, not B2B pricing issues. Look at steel. I mean, steel hasn't even come around yet. Steel is not likely to come around because we have a shortage in steel scrap, which is tied to the automobile industry. The automobile industry is a major source of steel scrap in the US. And with their production being down, as we just looked at, it means that we're not getting the steel scrap, and therefore we're not getting the steel output. Although steel production is up in the United States, it's up in Europe, it is down drastically in China. So we're seeing that problem ripple its way through the rest of our economies. Copper, you saw, was already moving into that disinflation mode. We're not there yet when it comes to steel, is this chart's message to us. Here is the consumer price index. This is a 12 over 12 rate of change. And you can see we have it going up to just under 6%. And if you followed the Fed or you followed business long enough, by now the Fed would normally be talking about, if not actively raising interest rates because of where inflation is at. But there's a new sheriff in town called Chairman Powell. And he doesn't care that the inflation rate today is at 4%. He doesn't care if it's at 5%, because now they average the history. And if the average is below 2.5%, and there's a reasonable expectation that it's going to stay below 2.5%, then they're not going to move on interest rates. And that's why so many people are saying they don't understand why the Fed isn't moving on interest rates. They have a different way of thinking about it now. You'll notice that our forecast, which are those dotted lines, has the next low in inflation, just as consumer inflation, coming at about 2%, 2.25% on the high side. You'll notice that's higher than each of the last three cycles. that's telling you that in our estimation, we're about to move from a period of resetting prices. When it goes down to zero, what you're doing is you're resetting prices, to compound inflation. We're just going to be seeing inflation increases upon prior inflation increases without any real reset. And the inflation we're talking about experiencing, and you see it here through 2026, gets worse on the other side of 2026. And it runs higher than anything we've seen on this chart on an extended basis. This inflation is going to change the way you invest money. It's going to change the way our economy functions, but it's not at our doorstep just yet. It's being driven by these four factors, really. Labor shortages, commodity escalators being built into more and more contracts. Our federal government's fiscal policy drives inflation. And then there's the huge surge in money supply that ultimately will be an underpinning for this inflation. Let me show you a reason why ITR thinks the Fed is right and the bond market is right, that these prices are going to come down. You're looking at gold, 312 rate of change, and we have shifted it 20 months into the future. The blue line is the consumer price index, 312 rate of change, so not the 1212. So the 312 is already capped. It's coming over just as it should relative to what the gold market told us 20 months ago. It is telling us that the Fed is right, that this is a transient period, that interest rates therefore are likely to stay low in 2022. But after that, when that gold starts going up again, you're going to have to set your watch for the next time we're under the threat of interest rates actually going up. And if the Fed is seeing things the way we are, they're going to start moving them up in 2023 at the latest. They don't become dangerous for us until later, but the trend starts. What we encourage people to do is just go back into your own business history and find out how interest rate sensitive your markets are. You know, we have some clients that thrive no matter what's going on in interest rates, and we have some clients that when interest rates go up, it really hurts their business. Depends on the markets being served and how they go to market. So that's a management note you might want to take upon yourself to look into. One of the reasons we have inflation starting at a higher level goes back to that fiscal policy and inflation log that I was telling you about. We have spending 312 rate of change shifted 26 months into the future. And we're not going to see the CPI go down toward zero or below zero because we're looking at an elevated level of spending. Go back to 2006, 2004 into that period. See where we were running at in terms of spending rate? That's where we are now. Now, maybe some of you are optimistic that the government's going to be able to rein in its spending habits and it's going to find fiscal responsibility. I'm afraid we don't share that expectation at this time. We expect the pattern is set. Therefore, inflation is going to be reaching a low about where that green line is. If you look over on the left-hand side, you'll see the 2%. This is how fiscal policy is impacting us. Fiscal policy is taxing and spending. And the green line here is a picture of deficit spending. When that green line goes down, it means the government is engaging in more and more deficit spending. And if it ever were to go above, that would be the government engaging in fiscal responsibility, or at least as it goes towards zero, relative responsibility. The blue line here is the US dollar's value. It's on a trade weighted exchange rate index. And what I'm hoping you can see is that when the green line goes down, when the deficit spending occurs, it drags down the value of the dollar. Now, the dollar is relatively high right now because of some worldwide concerns. I mentioned China earlier. Because of COVID, there was a natural default going to US dollar for safety. That as the world calms down, you can assume that the USD, the US dollar, is going to get weaker. And a weaker dollar breeds inflation. And for you international companies, I'm thinking about our sponsors here in particular, this change in the valuation of the dollar from what we've seen over the last 6 years to this likely declining trend through the rest of this decade is something the CFOs are going to have to contend with. It's going to impact profitability. Here we're taking the exchange rate and comparing it to inflation so that I can put picture to the words I just gave you. See, the green line it's counter-cyclical to the blue line, which is inflation. When the green line is low, then you have the blue line high inflation. And when the green line is high, that's when you have low inflation. And deficit spending is going to give us more weakness in the US dollar, which is going to give us more inflation. So I'm tired of saying the word inflation. You're probably tired of hearing the word inflation, but what I'm hoping you're doing is saying, okay, what am I going to do? Do I have a process, a business strategy where I can contend with this inflation, not only as it impacts my business, but as it impacts my family life? If there's going to be more inflation out there, clothing is going to cost more for the kids, food is going to cost more, gasoline is going to cost more, everything's going to cost more, which means I need more out of the business, which means despite labor costs going up, energy costs going up, I've got to draw more out of this business. I have to have a strategy. I have to have thought this through, or else you're going to be playing catch up dealing with this inflation. I mentioned energy prices. Here, when the green line heads up and it's on the right-hand side, you'll see it says inverted scale. That means that's the dollar getting weaker. And I flipped it around so you could see how the dollar value relates to oil prices. When that green line goes up, it means you have higher and higher oil prices. When the green line goes down, which would be a stronger US dollar, that's when you're going to get lower oil prices. You couple that with this age of ESG. I tell you what, I don't see how we're going to escape higher oil prices. That's going to drive a need for efficiencies. It should drive business your way. But if you're running fleet of trucks, it also means it's just going to be more expensive to run your fleet of trucks. There's a sea change happening here. Politically, oil and natural gas are on the wrong side of the political sphere. ESG is all the rage. And you have fundamental economics all running against us when it comes to keeping energy prices reasonable. And labor shortage. I've already alluded to that. This is the 12-month moving average for job openings in different industries. I mean, there isn't an industry out there where we're not seeing, maybe retail, where the job openings aren't crushing. You're manufacturing, that's a 12-month moving average. The monthly data is above 800,000 right now. This is not going to go away. We do not have a magic supply of labor. There's been a cultural shift that has removed people from the workforce, and not the baby boomers. It's really it's interesting when we looked at the graphics. It's the highly educated professionals that are opting out of the workforce, which I found that to be very interesting. It's like they're deciding because they had to during COVID, maybe we like either the mom or the dad staying home. Maybe we can get by with one income. It means we don't have daycare. I think that's a big part of what we see going on, and it's not likely to reverse in this decade. I alluded to this earlier. I was fascinated when I saw it. The U.S. labor participation rate. So with that green line coming down, it means there are people opting out of the labor force. They just don't want to. I mean, the blue line is the U.S. and they just don't want to be participating. It had nothing to do with COVID. You see, this trend has been going negative throughout this century, really, and accelerated post the Great Recession of 2008, 2009. I was surprised to see it happening in China also. I knew their population was going negative. They're losing about 30 million workers every 15 years. You can imagine what that does to their middle class. But their participation rate, which is green and scaled on the right, is waning also, which maybe it's a sign of how much their education programs have worked out and that they have developed a middle class. But their demographics and this trend are going to be very problematic for China going forward. In Sweden, very strong work ethic, apparently. Canada looks like the United States. although more acute there during COVID. But Sweden, there's no long-term decline here. In fact, there's a solid ascent since 2010 in terms of Swedish labor participation. I put this in the deck because, and I'm sorry I didn't make it obvious, where there's declining labor participation, there's an increasing need for automation. That'll be true in the US, that'll be true in China, that'll be true in Canada, won't be true in Sweden. You have to look at those factors when you figure out geographic markets. Another function of geographic critique is population growth. Where you see red, those are states that are losing population. Illinois, West Virginia, New York, Vermont, Connecticut. You can read the states. That's where the labor shortage is likely to be most acute, because if they have negative trends, it's because they're lacking the young people, they're lacking the millennials most acutely. They're not lacking in old people, they're lacking in the primary working age of the millennials. And some states have very little growth, like 0.1% for Michigan. Indiana looks strong compared to its neighbors, and it is performing well. Its GDP is better than its neighbors. But look at the dark of the southeastern part of the United States down through Florida. Look at Texas in the middle, and then over toward the West Coast. That's where you're going to find the most people. That's where you're going to find the strongest economic growth. That's where you're going to find demand remaining rock solid and supply actively seeking to catch up. For another little note before we leave this one behind, notice how the West Coast has shifted east. It used to be Washington, Oregon, and California dominated economically, population-wise, and they're paling out, literally. And the new West Coast runs from Idaho down through Arizona, Colorado, and Texas. Behold the change in the world. This is accelerating. So if you're in New York State, your problems are going to be a lot more acute and of different nature, really, than somebody in North Carolina or Georgia or Texas or Colorado. Can't come up with one universal answer, but it does mean that you were all striving to look for people. Sometimes they're just not there, and there's nothing you can do about it. A few financial thoughts, and particularly that means the stock market, and then we'll go into Q&A, Jose. This is the S&P 500. This is a long time. You're looking at 1920 on the left, all the way to where we are today. And we're on log scale, as you see in that subtitle. And what that means is we're not going up in equal index increments. We're going up in equal percentage increments from 1 to 10, 10 to 100, 100 to 1,000, et cetera. It is accurate, and any financial planner worth his salt, her salt, would be able to tell you that long-term, the market's going to give you a 7% rate of return. That's not adjusted for inflation. But I want you to see that they can say that because of what happens during the green periods, like where we are now with green arrow periods. We have consistently had these decade-long or even longer, as in the case of the 1920 through 1940 period, no growth. We hit these periods of no growth. Buy hold strategy for your retirement planning makes sense as long as we're in this green arrow period, because generally it's going to be going up. But we are going to hit a period where green turns to red. And it will be marked by a significant stock market correction. Now, it's my being politically correct. What it means is there is a bona fide bear market out there. That doesn't mean I want you to sell your stocks today. On the contrary, you shouldn't be out of this market. You should simply be rotating into the right sectors, which is something that we work on at ITR. This is a dangerous market, though. I don't want to fool you. Blue line again is the S&P 500, and again, we're on log scale. The green line here is corporate profitability. And you can see that profitability had a real tough time growing from post-Great Recession up until really the last couple of quarters, maybe more like 3 quarters now. That's PPP money turning into profits that's driving that green line up. This is something most Americans don't realize, is that giving away money without any strings attached, essentially, is what happened in the United States. That was relatively uniquely American. Most other governments went through making loans available, making sure the credit market stayed functioning. But we went beyond that. We just doled out money, and you can see it for corporations. It oftentimes turned into cash. But even with that, the delta between the blue line, which is the stock market, and corporate profitability is untenable. It won't last. Never has. Somewhere along the line, you may have learned that the stock market is supposed to reflect the present value of future corporate profits. There's no way that green line is going to go up there to match the blue line. This is like the dot-com bust of the late 1990s. And you can see how that worked out. You can see how it worked out in the Great Recession. The blue line comes down. This is another asset price bubble. This one's a little easier than the stock market, the housing market, in my opinion, in that we can look at when are we likely to, when have we in the past seen stock market go into these major declines? What are the circumstances? One of the circumstances is GDP is in recession. So if our GDP forecast is right, it says we don't have to really worry about a bona fide bear market until we're a lot closer to 2026, sometime in 2025. The other thing that we look at in terms of probabilities is back to that value of the dollar, or more importantly, deficit spending. When deficit spending is driving the dollar lower, the stock market tends to perform poorly. So stay tuned. For now, just be careful. Take some profit off the table is our encouragement to you. Don't get out of the market. Just go into some of the safe sectors. And if you want more information on this, just send me an email, which is why I put my email address right there for you. Bottom line, before we leave this behind and we go into questions, is we expect over the next 6 months, it could be 1 month, could be 6 months, that the stock market is going to give some people heartburn. We don't expect a bear market. I just tried to explain that. But you're going to see increased volatility. You're going to see some pretty historical headlines, or at least warning headlines. The bears come out of the woodwork. I want you to know that if that happens, it's built into our outlook. It's built into our decelerating rise. It's built into our outlook of ongoing growth. So you don't have to ask yourself, oh, did ITR, are they going to change their forecast because of what's going on in the stock market? Despite whatever the headlines are of the day, the answer is no, unless it's beyond the parameters of what we are already anticipating, in which case we'll let you know. But as of right now, we're expecting some turbulence, as they say on the airplane industry. Seatbelts are fastened in terms of the market, but there's no crash, there's no hard landing, there's no sudden drop in altitude. So let me summarize before we go into the questions. Supply chain issues will slowly abate over the course of 22, and in some cases linger into 23. You should be looking for opportunities with shorter supply chains. That just means more and more opportunities here in the US for manufacturing, distribution. When it comes to raising prices and all that inflation, I don't have the words there, so please hear me instead of reading. Find out what your competitive advantage is. What makes you unique? It isn't because you're the nicest person. It isn't because you're the safest person. It isn't because you give so much to charity, all of which are great things. But your competitive advantage is what defines you from your customer's perspective and your potential customer's perspective. What do they want? What are they looking for in an integrator? That's what you have to strive to be, and that's what you market, that's what you advertise. You find out what it is that they want by asking them. And then you make sure you can deliver on those 3 key points. And all of your talks, all of your marketing, advertising is wrapped up around those 3 points. You build your brand around those 3 points, and you'll be able to raise prices so that you are protected. from inflation, that your standard of living isn't going to suffer as inflation goes up. I emphasize a lot of the slowing. We just don't straight line forecast any percentages or even the data trend growth that you've experienced over the last 12 months. It's not likely to be the same for the next 12 months because there's that curve that begins in CapEx post 1Q 2022. Labor is going to be in short supply. Great for us. Think about deleveraging. Start asking yourself, how can I unwind come 2026? And then remember that retaining employees is always easier than attracting employees. And the best way to retain an employee is to have an absolutely great culture, treat them fairly, understand the work-life balances that they come with. You're going to pay them more than historically was normal, but welcome to the new paradigm. And they want to know that you as a company, as a team, are doing more than just making money. How are you giving back to the community, however you want to define the community? Millennials want to know that what they're doing is creating good beyond just what's happening in the company. If you can do that, you're going to have an easier time retaining people. Attracting people is all about your culture, selling them on your culture. Don't forget to innovate internally also. We help the world innovate. Don't forget to innovate yourself. And you got to do all of this, not best in the world, just better than your competition. Be better than your competition, and you'll have better growth than your competition. You will have better growth than what the economy is going to gift to you. And that's the name of the game. We have to do better than what the economy would otherwise just gift to us. Oh, sorry. All right. I told you earlier that would really love for you to take your businesses and compare them to capital spending, non-defense capital goods and orders. You can do that. Go on our website and you'll see that you can access what's called DataCast. It's our own software program for free. You load in your company data using Excel, and then you just compare it to all the series that we have in our ITR trends report, and the CapEx is one of them. Industrial production is one of them. The leading indicators that we've looked at are in there. Play for 30 days so that you'll know how all of this relates to you as an individual business. And then you really, really start amping up your planning certainty. Okay, Jose, are you there, sir?
Yes, I am back. I've been here the whole time. So thank you very much. This was like thought-provoking, more than thought-provoking virtual event. And we have some questions coming from our attendees. So the first one, and I'm going through the chronological order, is US consumers are purchasing homes at costs that are 20 to 50% higher than 2 years ago, and currently buying used cars and trucks $5,000 to $12,000 higher than they would typically be valued. Do you see any long-term danger in this?
Long-term danger is the housing price bubble that will eventually pop. But as long as inventories stay low, the demand is going to be there and those prices will be sustained. But remember that geographic population growth slide? I mean, you're going to find that happening more in Florida and Texas and Colorado, right, than you are in Illinois or Michigan. It's a function of where the people are and where the people want to be. So it is more dangerous in West Virginia, the pop, than it is, say, in South Carolina. That's how that works out. In terms of the automobiles, it's the same thing that's going to be true of boats and motorcycles. Wait 2 years, you're going to be able to get these things at a real price, because as new cars come on, people will be dumping these used cars, and you'll be able to get a pretty good bargain on it if you can keep what you have running for another 2 years.
Perfect. Thank you. So here's another question. China is asking its citizens to stock up on food. Are there any reasons behind this? Is food in shortage in China? Is this because of possible war with Taiwan? What is the implication of any one of these scenarios?
Well, asking your population to stock up on food is obviously scary. Exactly what they have in mind, I couldn't begin to tell you. It could be saber rattling regarding Taiwan. Let's hope that's all it is. It could be also economic. They've had severe power outage issues, and they're also having significant climate and environmental issues. And they're probably thinking that they're going to have to curtail some production facilities, and you don't want a hungry population on your hands in China. So it could be economic also. There's no way for me to know. It's just something that I'm glad this person spotted, and we're continuing to watch it carefully.
All right, perfect. Thank you. So this one was also on my mind because your brother has in the past talked repeatedly about the very real crash around 2030. That would result in us using our smartphones to find bread lines. So does this critical event still loom ahead around 2034 from your perspective?
Did anyone really say use our smartphones to find bread lines?
I just read the question.
I have a hard time imagining him saying that, but I'll have to ask him if he actually said that. Yeah, the timeline is the same. Okay. We've asked ourselves all the way through COVID and in this post-COVID economic environment, do we need to change that timeline for any number of reasons? And we've analyzed it forward and backward, and we are staying with the timeline because it's more than just the national debt. And that's the big variable that's changed, the acceleration of the national debt. It's also based on demographics, and they haven't changed. Rising healthcare costs, and that trend hasn't changed. Increasing entitlement spending, that hasn't changed. And inflation, we always knew inflation was going to be there. We just weren't sure exactly what the mechanism was going to be. Now we know. So that's not new. So we're keeping it the same. Let me put a non-breadline spin on this, though, okay? We showed the forecast at our July webinar, and you can still purchase that off our website. We see 6 years of decline in the US and global economy starting in 2030. Okay, that's awful, obviously. Let's say that unemployment goes up to 25%. Sort of like what it did in the 1930s. You can say, oh my gosh, breadlines. Or you can say, how do I make sure my business is doing business with the 75% of the world that is still working? How do I make sure my kids are in the right fields of study, the right career paths, so that they're part of that 75%? See, that's how I approach the whole thing, not as a scare, but forewarned is forearmed, right? Yeah. There's lots of things we can do to help our kids and our grandkids be ready for this eventuality.
Perfect. No, I totally agree with that attitude. So here's another question. With the decline in the strength of the US dollar, does that bode well for the value of cryptocurrencies?
I'm pausing because I'm going through the mathematics in my head and my overarching point of view. See, the cryptocurrencies outside of the United States are most popular in economies where the currency is unstable. So whoever asked this question, I think, is prescient in asking it. A weakening US dollar could drive people toward cryptocurrencies. But I don't want to leave the answer there, because cryptocurrencies will never replace the US dollar any more than they would replace the Chinese yuan. China's digitized part of their monetary base, right? They've taken paper out and put in digital currency instead. We're going to do something similar to that here in this country, because no government worth its salt of any size is going to allow cryptocurrency to drive monetary policy. There's always going to be a central bank that wants to control interest rates, how much money is out there, the value of the dollar. That's their whole reason for being. Now, Austrian economists would say good riddance to them, but the reality is they're here. And therefore, we're much more likely to disallow cryptocurrency on a large scale than to accept it. And here's another bias I have when it comes to cryptocurrency. I've been around long enough, and Jose, you may have been also. You've seen things come and go before that look like it's the surefire winner, it's the game changer, or it's the latest fad. And I know it's more than a fad, but when I was young, Jose, for me, it was investing in penny stocks and options, right? And if you got lucky, if you played it right, just like this playing a roulette wheel, if you do that right, you can make some money. But it's not a store of value. It's just where you go with some fun money to see what you can do with it. And that's my view of cryptocurrency. It's today's penny stock. It's today's options for this generation that has a tremendous amount of money for going for it and enjoys being on the digitized world, that platform. But it's not a store of value, and therefore it's not really investment grade from my perspective. But that's, a boomer's perspective.
Perfect. No, thank you. Thank you very much. I do have one question, and that is related to workforce mobility. So with the pandemic, we were all forced to learn to work remotely. And many of our members have become much more open to having remote workforces. Some were already doing that. But when you showed that map of the US with different states, with different, like the different colors because of like workforce ability, et cetera, and growth rates, I mean, does that workforce mobility, remote workforce, solve that problem, at least partially? Because now you can connect with anybody within the country or potentially even outside of the country.
You can, but you don't spend a whole lot of money advertising in Illinois, put it out there to attract the distributed workforce, because there's going to be a lot more of them in those dark green states than you're going to find in the Midwest, right? So all right, Jose, I don't know about you, but I find so many companies still are not comfortable with having a distributed workforce. They want their engineers in the office. They want their accountant in the office. And it hasn't become as ubiquitous as I would have thought it would be by now.
So I tell you what, this is like a great segue into reminding our members about our conference next year, because the theme is the future of work. And we will be exploring what it means for the people. It will explore also the location, and it will also explore the type of work that system integrators will be doing in the future, because that has also been changing in a very big way. So this is a very exciting topic, and I'm very excited to be able to have that take place at our conference. So let me close this event down. It was a fantastic event. So just 1 second, please. I want to remind our members that in 2021, we opted to deliver 2 virtual events by ITR Economics. We knew that we didn't have the opportunity to do it at the conference, but also that the economic landscape was going to be going through unprecedented territory. So that's why we have, the first one was in May. I also want to remind our members that we have this virtual event on a weekly basis. And here are the next ones that are coming. So we were talking a lot about the supply chain issues. So we're going to have the providers of the legal affinity program provide this virtual event. And then we're going to have our best practices committee talk about the development process and version of the 6.0, etc. I would like to thank our sponsors, Siemens and ePlan, very much for sponsoring the event. Thank you, Brian. I enjoyed this thoroughly. We had a big attendance. And if you want any one of us to reach CSIA, please do that. We're here for you. Thank you very much. Have a great rest of the day.
Thank you.